Welcome to House Lux Estate, your ultimate guide to understanding financial concepts and investment strategies. We're here to provide you with a wealth of knowledge on a broad range of investment-related topics, all in an easily digestible format. Today, we're going to tackle a topic that might sound complex, but is actually quite fundamental to understanding the world of finance: the impact of share buybacks on corporate valuation. This topic is essential for anyone looking to make informed investment decisions, as it directly impacts the value of the companies you might be interested in investing in. It's our aim to break down this complex issue and make it understandable, even if you're new to the world of finance. So whether you're an experienced investor or just starting out, this video will offer valuable insights. Stay with us as we delve into the world of share buybacks and their influence on corporate valuation. To explore the impact of share buybacks, we must first understand what they are. In the simplest terms, a share buyback, also known as a stock repurchase, is when a company decides to buy back its own shares from the marketplace. You can think of it like a company shopping for its own stock. But why would a company want to do this? There are several reasons why companies choose to buy back shares. One of the most common reasons is to reduce the number of outstanding shares in the market. When a company reduces its number of outstanding shares, it increases its earnings per share and often leads to an increase in its stock price. This can make the company look more attractive to investors. Another reason for share buybacks is to take advantage of undervalued stock. If a company believes its stock is undervalued, it may choose to buy back shares, betting on the fact that the stock price will eventually rise. A third reason for share buybacks is to offset the dilution caused by employee stock options. When employees exercise their stock options, new shares are created which can dilute the value of existing shares. By buying back shares, the company can mitigate this dilution. Now let's talk about how a share buyback works. It's not as complex as it might sound. A company will announce a buyback program, detailing how many shares it plans to buy and over what time period. It then buys the shares on the open market, just like any other investor. Once the shares are bought, they are often retired, meaning they are removed from circulation and no longer traded on the open market. It's important to note that not all share buybacks are created equal. The impact of a share buyback on a company's financial health and stock price can vary widely, depending on the specifics of the buyback and the overall market conditions. Now that we have an understanding of what share buybacks are, let's examine their impact on corporate valuation. The relationship between share buybacks and corporate valuation is quite interesting. It's an intricate dance of numbers and strategy that can significantly influence a company's worth in the market. So, let's dive into the details. You see, when a company decides to buy back its own shares from the marketplace, it's essentially reducing the number of its shares in circulation. This decision is never made lightly. It's a strategic move, often indicating that the company believes its shares are undervalued. Now, you might be wondering, how does reducing the number of shares in circulation impact corporate valuation? Well, it's pretty straightforward. When there are fewer shares in circulation, the earnings per share, EPS, increase. Earnings per share is a critical measure used by investors to gauge a company's profitability. It's calculated by dividing the company's net income by the number of outstanding shares. So fewer shares mean higher earnings per share, all else being equal. But that's not the end of the story. An increase in earnings per share can potentially boost the company's stock price. It's simple supply and demand. With fewer shares available and higher earnings per share, each share becomes more valuable in the eyes of investors. This can drive up demand, leading to an increase in the stock price. And here's the kicker. A higher stock price means a higher market capitalization, which is a key indicator of a company's value. Market capitalization, often referred to as market cap, is simply the stock price multiplied by the number of shares outstanding. So, a higher stock price directly translates to a higher corporate valuation. But let's not forget, share buybacks are not a guaranteed recipe for success. They can be a double-edged sword. On one hand, they can signal confidence in the company's future prospects, attracting investors and driving up the stock price. On the other hand, they may also suggest that the company doesn't have better investment opportunities and is using its cash reserves to artificially inflate its stock price. Also, while buybacks can increase earnings per share, they do not necessarily increase the company's overall earnings. The company's profitability is not automatically improved by a share buyback. The EPS has merely been concentrated among fewer shares. In conclusion, while share buybacks can certainly impact corporate valuation, They are not a one-size-fits-all solution for every company. They are a tool, one of many in the corporate strategy toolbox, and they must be used wisely and strategically to yield positive results. As we can see, share buybacks can have a significant impact on a company's valuation. They can increase earnings per share, potentially boost the stock price, and consequently raise the company's market cap. But their effectiveness depends heavily on the company's overall financial health, future prospects, and strategic decision-making. To fully grasp the impact of share buybacks, let's look at a hypothetical scenario. Imagine a company, let's call it Bright Futures Incorporated. Now, Bright Futures has been performing exceptionally well in recent years, and they've managed to accumulate a significant amount of cash. The management is now considering ways to optimize this cash for the benefit of shareholders. One option they have is to issue dividends, which would distribute the cash directly to the shareholders. But Bright Futures decides to go another route. They decide to implement a share buyback program. So what happens next? Bright Futures announces their intention to buy back, let's say, 10% of their outstanding shares. This news creates a buzz in the market. Investors anticipate that the share price will rise due to the reduced number of shares in circulation, and this expectation can cause the price to increase even before the buyback is initiated. Now, Bright Futures starts buying back shares from the market. As the number of outstanding shares decreases, the earnings per share, or EPS, a key metric investors look at, increases. This is because the same amount of earnings is now spread over fewer shares. This increase in EPS can make the company look more attractive, leading to a higher share price. However, it's important to note that the real value of the company, its assets, and its ability to generate future earnings has not changed. The increase in share price is driven by a change in perception rather than a change in the company's underlying value. At the same time, Bright Futures equity decreases as they use cash to buy back shares. This increases the company's financial leverage since the proportion of debt to equity can increase. Higher leverage can lead to higher risk, but it also can lead to higher returns as long as the company continues to perform well. So what's the end result? Bright Futures has successfully returned cash to its shareholders, not through dividends, but through an increased share price. The shareholders who sold their shares have made a profit, and those who held onto their shares now own a larger percentage of the company. The increased EPS and potentially higher share price can make the company more attractive to investors, which can further drive up the share price. However, the company is now more leveraged, and if the company's performance were to falter, this could lead to a decrease in share price. In addition, the company has used up cash that could have been used for other opportunities such as investments or acquisitions. This case study gives us a practical understanding of how share buybacks can influence a company's valuation. As we wrap up, let's summarize what we've learned today. We've explored the concept of share buybacks, a strategic tool companies use to repurchase their own shares from the marketplace. We've seen how this can be a beneficial move for a corporation, as it can reduce the number of outstanding shares, thereby increasing earnings per share and potentially boosting the company's market value. We delved into the relationship between share buybacks and corporate valuation, acknowledging the nuanced impact that these buybacks can have. We also examined a real-world case study, offering a practical perspective on how share buybacks work in action and their direct influence on a company's valuation. This understanding is essential as it can provide valuable insights for investors, helping them make informed decisions about their investments. And that, after all, is what we're all about here at House Lux Estate. Thank you for joining us today on House Lux Estate. Don't forget to subscribe for more insights into the financial world. See you in our next video.